Hello, everyone, and thank you for joining. It's 10 now, so I'm going to get started just first with a few quick little housekeeping and overview things before we get started with the actual webinar. But thank you all for coming today. My name is Claire Ladd, and I'm the Programs and Services Manager at the Massachusetts Nonprofit Network, MNN. We're glad to have you here today for a webinar. Just a few quick housekeeping items before we dig in. The recording and the slides from today's program will be emailed to you, so please keep an eye on your email for that in the next couple of days. During the webinar, if you have any questions for the presenter, please submit it via the Q&A function. There will be plenty of time to answer questions during the webinar. If you have any questions about MNN or anything like that, you can drop those in the chat and I can respond. I also want to give a little background about us here at MNN. Our three goals are to strengthen the nonprofit sector through advocacy, public awareness, and capacity building services. So we offer these regular webinars in partnership with our affiliate members as part of our capacity building efforts. Please stay tuned for future topics and let us know if there's any topics you'd like to see. Our efforts are made possible by more than 600 member organizations. So thank you to those of you who are members. But if you have not yet joined and would like to take advantage of the member benefits such as networking opportunities, cost savings, please visit massnonprofitnet.org/join to find out more. Okay, today's webinar is titled From Financial Freakout to Prosperous Nonprofit, and it will be presented by Stephanie Skryzowski of 100 Degrees Consulting. I'm going to hand it over to Stephanie to get started.
Wonderful. Thank you so much, Claire. It's great to see everyone here today. Thanks for joining me this morning. I'm so excited to talk to you today and hopefully move everyone from freaking out about your finances to being a more prosperous nonprofit. So, like Claire said, my name is Stephanie Skryzowski. I am a nonprofit CFO. I am the founder of 100 Degrees Consulting, and we provide bookkeeping and financial strategy services to help nonprofits increase their impact and their income. I've spent the last 20 years or so working inside the nonprofit sector and then in my business. And so this is just what I live and breathe and do every day. I love nonprofit finance. Okay, so when I ask a question to nonprofit leaders, what is the biggest challenge that you have when it comes to managing your finances? In other words, why are you freaking out about your organization's finances? And the number one answer I get is that I'm afraid that I don't know what I don't know, and I'm afraid that I'm missing something. And so my goal today is to help you feel confident that you're not missing anything. So then I ask the question, of course, what would be possible if your finances were up to date and organized? And it always comes down to more grants, more funding, and more impact. And so I always want to tie that back, that financial management, it all comes down to being able to use our resources more effectively so that we can have a greater impact. All right. So, some of the challenges that I see inside the nonprofit sector, I have the privilege of being behind the scenes of hundreds of nonprofit organizations. And over half of US nonprofits have less than 3 months of cash on hand. So, if not another dollar came in the door, they could run their programs for another 3 months and then they'd have to stop. We are also seeing growing expenses, right? We have all been impacted both personally and probably inside our organizations from inflation. And we're also seeing the increased need for our services. So that's driving up expenses for nonprofits. Then on the other side of things, lower revenue. Funding streams are shifting or drying up, some overnight. And the Nonprofit Finance Fund just released their 2025 study of nonprofits and found that 36% of nonprofits ended FY24 with a deficit, meaning they spent more than they brought in. Then, when we're talking about inside the nonprofits and looking at our staff, nonprofits don't have the right finance people on their team. Burnout, turnover are widespread. I think we've all seen that and probably felt that as well. We don't have the right people on our team because only 41% of organizations can pay all full-time staff a living wage and benefits are limited. Y'all have maybe experienced this yourself. And finally, we have dysfunctional systems. We have outdated software systems and processes that do not provide us clear financial information in a timely manner. So, this is why we are freaking out about our finances. So, today we're going to talk about three main areas, three ways that you can begin to master your nonprofit's financial health and go from freaking out to feeling like a prosperous nonprofit. And those three areas today are understanding the key reports that you should be looking at every single month, calculating some metrics to help you better understand your organization's financial health, and then forecasting the future, looking into the future of your nonprofit's finances so that you can predict when things are going to happen and make changes accordingly. So let's dive right in. We are going to waste no time today. The one thing I will say is that if you have questions, please drop them into the chat. And if we have time, I will make sure I answer those. And number two, I'm going to ask you at the end of our hour together today to think about what you're actually going to take action on after this webinar, because I do not want you to spend 60 minutes with me today and not actually do anything afterwards, right? That's the key. We need to take action. So as I'm going through, I want you to be thinking about, okay, how can I apply this to my organization? What am I actually going to do? Be jotting that down. I'm going to ask you at the end what your action item is. So let's dive in. So, the first thing we're going to talk about today is the four financial reports that you should be looking at every single month. Okay, we're going to go into each one individually now. The first is your comparative income statement. It may be called a P&L or a profit and loss. It may also be called a statement of activities. These are all the same thing. And so you can see here at the top, we have our income. So all of our revenue by line item, foundations, individuals, government, etc. Then we have all of our expenses by line item, personnel, occupancy, travel. And then we have our net income, revenue minus expenses at the bottom. Now, the key here, and one area where I see a lot of nonprofits, what a lot of nonprofits are not doing is looking at a comparative income statement, right? Often I see nonprofits looking at just this column here. So this is January to December 2023. But without having a comparative period, we have no idea if these numbers are good or bad or high or low. Is $2.1 million in revenue the highest we've ever seen, or is that our lowest year yet? That's why we need a comparative period here to be able to compare the current period to what last year or whatever it might be. And I also like including the dollar amount change and the percentage change. Your accounting system can do this report for you just like this. You don't have to be an Excel whiz or anything like that. I know in QuickBooks Online, it's a click of a couple buttons and you have this report. So, number one, comparative income statement is what you should be looking at every single month. Number two, a comparative balance sheet. So you sense a theme. We've got comparative here as well. I need to be looking at the snapshot as of December 31st, 2023, compared to something else. So I know kind of the trends, the direction that I'm going. In this case, we have compared to the same period last year. You can see that we also have the dollar amount and the percentage variances. And just for a quick refresher, your balance sheet is a snapshot in time of all of the balances in your on your account. So all of your assets, your bank accounts, any receivables, any fixed assets like equipment or vehicles. Then the next section is your liabilities. So that's what you owe, right? Accounts payable, credit cards, any loans that you might have. And then equity is at the bottom, and that's essentially assets minus liabilities or your net worth, for lack of a better term. So this is the second report you should be looking at monthly, your comparative balance sheet. The third report that you should be looking at monthly is the budget versus actual. Now, usually, if I ask for a show of hands and say, which reports are you reviewing? Almost everybody says they're looking at their budget versus actual. That's great. We need to make sure that your budget is entered into the accounting system so that you can very easily pull this report. But once it is, this is the click of a couple buttons to compare your actual revenue and expenses for this year or this month compared to the budgeted revenue and expenses for this year or this month. And then the last report that we should be looking at every month is our statement of functional expenses. Now, you will notice that this looks like the income statement where we have our income over here, followed by our expenses. But you'll notice we have a couple different columns where we're breaking things out by admin, fundraising, and programs, right? And typically you would probably have multiple columns for each of your programs here. And so I'm going to share with you in a couple minutes why this one is important. But this doesn't necessarily come out of QuickBooks or your accounting system exactly like this unless you have set the accounting system up to do this. You have to tell QuickBooks, this is an admin expense, this is a program expense, so that it can generate a report like this. But once you do, then this report is also the click of a couple buttons. So now, if you are not a finance person, that is fine. You don't need to be. This is not like an accounting class, but I want to just point that out that you can ask your bookkeeper or your finance team for these four reports. So if you're not getting them on a monthly basis, this is something you can definitely ask for. And any bookkeeper or finance person should be able to pull these right from the system for you. Okay, now we're going to dive into some metrics. So, how to use these reports to calculate your financial health, to communicate it, to understand it a little bit better, and then make decisions. So the first metric is revenue diversity. We're going to be on the income statement for this one. And revenue diversity just measures the percentage of revenue coming from each source of revenue that you have. So in this case, we'll take one revenue source like foundations and grants of 1.1 million divided by total revenue of 2.1 million, and we get 54%. So this organization brings in 54% of their income from foundations and grants, right? So that's a lot from one area. If I were actually analyzing these financial statements, I would probably drill down into what makes up this 1.1 million to see, is it like one grant for $1 million, or is it, 10 grants of $100,000 each? I would make sure that I kind of understand really how diverse my revenue portfolio is, right? We don't want to have all of our eggs in one basket. I think a lot of organizations that were relying on government funding, were sort of in trouble earlier this year when that government funding was abruptly cut for a lot of nonprofits. And so just understanding your diversity is really important. The next metric on the income statement is revenue and expense growth. And this is really just measuring the variance from the prior period. So that's why having that comparative income statement is important. And you actually don't have to do any math here because your accounting system should do it for you right over here. And so we're just seeing the trends. How are we moving from one period to another, from one month to the next, or one year to the next? In this case, you can see that their income has gone down by 638,000 from year to year. Their expenses have gone down by 547,000 or 22%. So in this case, I can see that revenue's gone down, expenses have also gone down. Maybe this is just a lower year for this organization, right? So wanting to sort of see the trends there. One red flag might be if you see income going down, but expenses going up, right? You might dig into that to understand a little bit more what's going on. So the third metric on the income statement is your burn rate. That's your average monthly expenses. We need to understand how much money is going out the door every single month. What does it take to keep the lights on and run our programs? So to get our burn rate, we will just take our total expenses of 1.8 million in this case, divided by 12 months, because we're looking at a 12-month period here, and we get $158,000 per month. So this organization spends $158,000 a month to run their programs and to keep the lights on, to pay their salaries, $158,000 a month. Now, another way that you can calculate your burn rate is actually to look at your budget for this year, right? Because if you're looking at last year, that may or may not still be relevant, right? Maybe last year was an extraordinarily big year. You started a bunch of new things or whatever. Or maybe this year is going to be a lot bigger. You've got some growth plans. So you might want to take your budget and divide that by 12 to get your burn rate. That's another way to calculate it. The next metric that we can calculate on the income statement to really better understand our financial health is our operating margin. So we are a nonprofit, yes, but that does not mean that we cannot have any money left over at the end of the year. And so that's what this is measuring. It is measuring the percentage of revenue left over after expenses, right? So we're going to first get our net income. So that's income minus expenses. So 239,000 divided by our revenue of 2.1 million, and we get an operating or profit margin of 11%. Now, there is no like you're not going to get in trouble by the IRS or by anyone else if you have money left over at the end of the year, right? In fact, I would say that sustainable organizations do have a surplus. That is how we build a cash reserve. That is how we make sure that we have cash to weather any unexpected expenses or drops in funding. Um, this also may be the case if there are some timing differences between when you're recognizing revenue and when you're actually spending the expenses for that revenue. So there's lots of reasons that you may have a surplus here. But if you're thinking about your budget, you may consider budgeting in a margin of 5 or 10% to make sure that you do have money left over and you can build a cash reserve. Because remember what I said, over half of US nonprofits have less than 3 months of cash on hand. So if you don't have 3 months, that might be a good place to start. And building in a margin like this is the way to do that. The next income statement metric is your expense ratios. And so that is just measuring what percentage of your expenses go to program, admin, and fundraising, right? So we often get asked the question, how much of our donation goes towards programs? So we need to know this number. And the other thing is, this is a report that goes on your 990 and on your audited financials if you have an audit. So it's important to be able to generate this report and to be looking at it monthly versus just at year end when we're preparing the 990. So in this case, we're just taking our total expenses for that category, 833,000, divided by our total expenses overall, 1.8 million, and you get admin expenses of 44%. So that's kind of high. Maybe they need to allocate some expenses across programs and fundraising. Maybe they haven't done that yet. But this is an important number to know. Okay, so we just talked about our income statement metrics. We are going to move on and talk about our balance sheet metrics. So remember, the balance sheet is our assets and our liabilities. So the first metric on the balance sheet that we want to look at is our asset composition. So we want to really understand the balance between liquid assets like cash and other assets that are not so liquid, like fixed assets, for example. So how to calculate this? We're just taking the asset category. So say cash accounts of 378,000 divided by our total assets of 426,000. This is showing us that 89% of our assets are in cash accounts. That's a pretty strong place to be. I've seen some organizations look like they have a very strong balance sheet, but when you kind of dig in underneath total assets, you'll see that, maybe 90% of their assets are tied up in as fixed assets like vehicles and other things like that, where they don't have a lot of liquid assets. So this is important to understand your balance and to help you understand your balance sheet a little bit deeper. The next metric on our balance sheet is asset and liability growth. And this, similar to the income statement, is just measuring our variances from the prior period. And so again, with the comparative balance sheet, we have our variances built in here. So again, I just like to see the movement from period to period. How are we trending? Are we going up? Are we going the direction that we want to go? In this case, you can see that cash is actually down by about 10% or $147,000 from one year to the next. Receivables are also down. So if I'm seeing those two things going down, I might be saying, okay, what's going on here, right? In this case, we can also see accounts payable. So liabilities are going up a little bit, right? So this is just looking at the trends over time. The next ratio on our balance sheet is the quick ratio, and this just measures our ability to cover our debts. Now, all we're doing here is we're taking our total current assets divided by total current liabilities, in this case, 1.4 million divided by 222,000, and we have a quick ratio of 6.6. Now, this is the one that kind of sounds like accounting lingo, but the quick ratio just measures your ability to pay your debts. We want to make sure we have more current assets than we do current liabilities, right? So what this is saying is that we have 6.6 times the amount of current assets as we do current liabilities. We could pay our debt 6.6 times over with the current assets that we have. So that's good, right? The higher, the better. We want this number to be at least one, and the higher, the better. Now, I know a lot of organizations that really don't have any debt, right? Maybe there's some accounts payable and credit cards that are paid off within 30 days. So the only reason they land on the balance sheet is because of timing, right? Maybe they'll be paid, shortly after this balance sheet was run. So this might not be relevant to you. So as I'm telling you and inviting you to think about some action items, things you're going to do, if things aren't relevant to you, maybe you don't have any debt, don't calculate the quick ratio. It's not worth your time. It is not going to give you any more clarity on your financial health. Okay, so not everything applies to everybody. I just wanted to share that quick reminder. So the next balance sheet metric is our restricted versus unrestricted net assets. And this is measuring our ability to fulfill donor requirements and to demonstrate good stewardship of restricted funds. And so on your balance sheet under the equity section, you should have restricted net assets and unrestricted net assets. So in this case, we'll just take our restricted 671,000 divided by total equity of 1.8 million, and 36% of our net assets are restricted. So that means that 64% are unrestricted, and we need to make sure that we have the cash and the other assets to cover our restricted portion, so that we're not inadvertently, accidentally spending restricted dollars on something that they shouldn't be. That's why it's important to know what this number is. So this is you can check your balance sheet under the liabilities and equity section for this. And the final metric on our balance sheet, perhaps my favorite, is months of cash on hand. And this is measuring how many months could you operate if not another dollar came in the door, right? So we talked about this a little bit this morning, or in the beginning, that a lot of nonprofits, most US nonprofits, have less than 3 months of cash on hand. So this is an important number to know, and one that I look at every single month. So to calculate this, we're just taking our total cash balance divided by our burn rate. So our total cash balance of 1.2 million divided by that burn rate of 158,000 that we calculated a few slides ago. And at this point in time, this organization has 7.6 months of cash on hand. So not a bad place to be, but it's very important to calculate this number monthly, because maybe in this scenario, maybe they just got a huge influx of cash, but the expenses haven't gone out the door yet. And so this could be sort of artificially inflated. That's why we need to be looking at this number monthly. Now, a good place to be is, 3 to 6 months. If you're not at 3 months, if you're one of those organizations that does not have 3 months of cash on hand, maybe that's your first goal, is to, okay, let's build in a little surplus this year so we can start putting away some money and have a 3 month cash reserve. If you're already at three, maybe you want to try for six. I know one organization that hit that 3 months, and so they said, okay, we want to build a 6 month cash reserve. And so now they're actively working towards a 6 month cash reserve. So what the right number is, there's no right or wrong. It depends on your organization and your needs and your expenses and your revenue streams and, how reliable they are. So lots of factors to think about, but we want to be looking at this number every single month. Okay, so we can use these metrics to help us manage expenses and burn rates and make sure we're on track for whatever our goals are. We can use these metrics to help craft a narrative. Maybe, you need to shift your fundraising direction, and you can use some of these metrics to help you sort of make your case for that. And you can also use these metrics to help you build a plan, right? To help you think about what is the best move for our organization? How do we plan financially for potentially losing a grant that we've had, right? You can use these metrics to help you do that. So I want everybody to think about maybe one or two metrics that you are going to take away from today and actually go back and calculate. Like Claire said, you're going to get these slides, so you will be able to go back and look at how you actually calculate each of these metrics. But I want you to think about maybe one or two that you're like, oh, I think that would be really useful to understand that for my organization. Okay, so make sure you write that down. So, one to two metrics. I have three on here, but one to two. Which one to two are going to best help you understand your finances? Make sure you write those down. Okay, in the interest of time, we're going to keep rolling. So, the next thing we're going to talk about is really translating some of these metrics into a narrative, a story. Because I really believe that when we share our numbers, I like this quote by Seth Godin, the right information brings knowledge, and knowledge is power. Sharing it is empowerment. So, being able to share our numbers really empowers those people that we are giving that information. And I believe that everyone in our organization needs to know the numbers in some way, shape, or form. And I have seen that when we were more transparent about our numbers, people feel a greater sense of ownership. And when they feel that greater sense of ownership, they are more engaged. And that goes for everybody from your staff to your board to your funders. And I think we all want more engaged funders, right? There was a recent study by GuideStar that showed that transparent organizations that were more transparent about their financials, about their programmatic impact data, received 53% more in contributions the following year. So they were more transparent about their numbers and then they raised more money. So that's huge. And being transparent and sharing your numbers in a meaningful way also really helps build trust with donors, with your board, with volunteers, with your staff. And that means people are going to stick around longer and continue to support you. So, that being said, we do not want to just share those financial statements far and wide, the financial statements that we were just looking at, because a lot of times people do not have the understanding and the ability to interpret those in a meaningful way. So we need to provide context. So when I think about the right combination of sharing financial information, I'm always thinking about who's my audience, right? Does my audience understand financial statements? Or have they maybe never seen a balance sheet before, right? Because that's going to impact the way that I share those numbers. We're going to think about who we're talking to. We're going to think about the frequency by which we share this information. So your board should likely be getting financial statements on a regular basis, maybe monthly, maybe quarterly. Maybe your staff should be looking at the financials, or you review the financial statements with your whole team, maybe on a quarterly basis, right? I think the key here is to figure out your frequency and then keep it consistent, right? We don't want to share our financial statements or some highlights from the financials with our staff once and then never again, right? If we're going to do it, let's do it every quarter, whatever it might be. And then finally, the format. We want to make sure that we're sharing our financial information in a format that is going to get the biggest impact from those that we're sharing it with, right? And so again, we probably wouldn't do like, say, an email blast to everybody on our email list with our income statement and our balance sheet directly from QuickBooks on a monthly basis. That would not make sense. What we might do is maybe we share a couple bullet points of highlights of where we are this quarter. Maybe that's what we share, right? So we need to think about what the best format is, whether it's the full financial statements that you send to your board or some sort of dashboard, or maybe just a narrative like we're going to talk about in a moment. So I wanted to grab a couple of the metrics that we calculated and show you how I turn them into a narrative, show you how I can sort of turn them into a story. And you can do the same thing with your organization. So looking at revenue diversity, this is measuring the percentage of revenue that comes from each source. The story here is that we've historically been reliant upon foundations for nearly half of our annual revenue, But with changing priorities in the sector, we're trying to increase our individual donor base for ongoing sustainability. So this might be a story that you're telling to your board as you want them to engage their networks for individual fundraising, right? Or, maybe this is in an email that you are sending out to all of your current donors, asking them to forward the email to two new people, right? Whatever that might be. But it's taking that metric and turning it into a story that people can connect with, right? They're going to connect with this more than they may connect with, here's our income statement, right? So expense ratios, here's an example from the statement of functional expenses, which shows what percentage of our expenses are going towards each of those areas, admin, fundraising, and programs. So the story here is that over 80% of our expenses go towards programs, with the other 20% to support crucial administrative costs, such as financial oversight, insurance, and fundraising. So we can share where our money is going, right? We often get asked this question by funders. I get asked the question a lot. Well, how do I sort of justify a higher, we had a lot of startup expenses or we had a big investment this year. And so our admin expenses are really high or higher than normal. This is a perfect opportunity to explain that, right? And often we have this broken out on our annual report, and so we can include a couple bullet points or a little text box that shares what did we spend those, that 20 or 30% admin on. So again, a way of translating the information into something that people can grasp onto and understand. Months of cash on hand. So, like I told you, this is my favorite metric and the one that I think everyone should be looking at. But the story here is that on average, we hold roughly 2 months of cash on hand. In order to continue our ongoing legacy of programmatic impact, we're working towards building a cash reserve of 6 months of cash on hand. And maybe you're telling this to your board as you are showing them, presenting the budget for approval. And there's a big surplus in the budget, and maybe there's some questions or some discussion around it, and you can share, well, this is why we're budgeting for a surplus. We have 2 months of cash on hand. We're working towards building six, right? Restricted versus unrestricted, right? This is from our balance sheet, that section at the bottom that shows how much of our net assets are restricted versus unrestricted. We can say currently only 36% of our net assets are unrestricted. The other 64% are restricted for program purposes or used within a specified time period. We are currently seeking unrestricted funds to cover essential operating expenses, right? And so maybe this is in a conversation or a story to a potential funder. You're writing a grant. Why are you asking for unrestricted funds? And you can sort of explain it that way, right? So we want to take those metrics that we are talking about and turn them into a narrative that people can really understand and grasp onto. So I want you to think about what story you may need to share at your organization. Which of these metrics are really resonating with you? And you're thinking, oh, yeah, I need to calculate that number and then turn that into a story to share with your board or your funders or your entire audience, right? Everybody on your email list, whatever it might be. So I want you to think about that because maybe this is your action item, right? I'm going to ask you all at the end what that action item might be. Okay, so the third piece of really moving from, being stressed out about your numbers to feeling really calm and confident, feeling like, okay, we've got things under control. We have a prosperous nonprofit. The third piece of that is forecasting your future. So, everything that we talked about to date has been looking at the past, right? What has already happened. So, we can't change that, right? What's on our income statement and our balance sheet, we cannot change that. That has already happened. That's history. What we're talking about now is looking into the future and forecasting, thinking about what is going to happen. So I just want to share really quickly the difference between a budget and a forecast, because I've heard people sort of use the terms interchangeably, but they are not the same thing, right? So your budget is created once a year right? It's approved by your board before the beginning of the fiscal year. It's based on, your goals and your assumptions when you're creating the budget, and it's static, right? You're not changing the budget throughout the year unless there's some like massive shift in things in the organization, right? You are not changing that budget. You use the budget as a tool throughout the year, budget versus actuals, it remains static. Now, on the other hand, your forecast is updated. It is updated on a very regular basis. With the clients that I work with, I'm updating the forecast on a monthly basis. And the forecast is based on actuals, so what has already happened for, the first part of the year, plus updated assumptions. So, for example, right now it is September and I am starting to create 2026 budgets. So, calendar year 2026 budgets for my clients, but it's September, right? So I have no idea what's going to happen in April of next year. That's over 6 months away. But I'm going to use the best information that I have today. However, when April rolls around, I'm going to have way better information on what revenue is coming in, what expenses are going out the door. And that's the power of a forecast, is that we sort of have more real-time information helping us look ahead. So I see the forecast as a management tool for leadership. I'm not typically sending this forecast out to our funders or anything like that. I'm using this internally. I do often share it with the board. But a forecast helps you be really flexible and responsive because, maybe you lost a grant that you really thought you were going to get and that was in your budget. Well, now we need to update the forecast to reflect those changes. So forecasting helps identify gaps early, right? You can see revenue shortfalls before they happen. You can see overspending before it happens. You can see a cash crunch before it happens. And then it supports scenario planning and decision making, right? So you can figure out, okay, if we don't want this gap in cash to happen, what can we do now to make it so it doesn't, right? It can build board confidence and funder confidence. I shared that I'm not typically sharing this with funders, but if they know that you're on it, you're looking ahead, that really does help build confidence. There's smarter hiring, spending, investments, and you can really align finance with programmatic agility. And what I mean by that is, you know, as you're having to shift programs around, perhaps to meet the need of the community or the people that you serve, you can align finance too. You don't have to create a whole new budget. You can update the forecast to reflect, what we're doing today with the programs. And so you have this really clear picture of your finances. So how do we build a forecast? Like, what does this actually look like? So I'm always starting with the budget, right? Let's not reinvent the wheel. I already spent a lot of time putting together the budget and I used the best information I had at the time. So we're going to use that as our baseline for our forecast. Then we're going to pull in actuals. So it's September right now. I have actuals for January through August. So I'm going to pull actuals for every single month so that I have I know exactly what has happened for every single month. Then I'm going to update my assumptions for the rest of the year. So I'm going to adjust my revenue and expense forecast for September through December. Right now, I have a way clearer picture of what grants and other fundraising and other revenue is going to come in for the last 4 months of the year. A way better idea of that now than I did, when I created the budget almost a year ago. So I'm going to update those assumptions for the rest of the year. Then I'm going to, we're late in the fiscal year right now, so I'm always going to extend it to the year end or make sure I have a 12-month rolling. So I'm not just looking at the next 3 months, but I'm looking, I mean, honestly, for most of my clients, I have them forecasted out through the end of 2026 at this point. So is it perfect information? No, it's definitely not. I don't know what's going to happen in October of 2026, but I have my best assumptions possible through not only the end of this fiscal year, but through the end of next fiscal year. Because it's important that we're looking at least a 12-month time horizon so that we can see trends and kind of the trajectory of how things are going, right? And then the last thing that I want to do is look at the impact on cash flow, right? Because if, different revenue is coming in at different times, or, we're hiring or shifting programs around, that is going to impact the amount of cash in the bank. Right. And so we need to be able to see that. And in fact, using a forecast like this has helped, it has helped organizations avoid running out of money. Because when you kind of map it all out month by month, and I'll show you a template in a second, when you map it all out month by month, you can see 6 months into the future. And oh, okay, well, if we do all of this how we had budgeted, we're actually going to run out of cash. So we need to maybe move forward the timing of that particular fundraising campaign, and maybe we need to delay hiring of this position so that we don't run out of cash, right? But you can see into the future when you are doing this forecasting activity. So this is what I mean. And I have a template that I can share with you, but my forecast is a combination of the actuals, like what has already happened, plus projections. So looking ahead to the rest of the fiscal year and potentially even 12 months into the future. So I've got this combination of actuals plus projections. And in here, this section under projections, this is what I update every single month. So for example, maybe, we just closed, it looks like March. Well, now I know that this $200,000 grant that I was going to get in June is not coming anymore. They decided that we're not getting it. And so I'm going to update the forecast. I'm going to cross that off. But maybe individual donations are really trending stronger. So I want to increase that a little bit. Maybe we're going to do a big year-end campaign for individuals. So I'm actually going to increase this forecast to $20,000, right? We have more information today than we did when we created the budget. And so we are going to update all of this. We do the same thing on expenses. So we update our expenses. We thought we were going to hire somebody in May, but we're actually going to delay that hire to July. Great. Let's update the forecast so we have this crystal clear picture of what our finances are going to look like. So then in the template that I have, this ties to a cash flow forecast. And so you can see we have our opening balance. How much did we start the month of March with? $93,000. We have what came in, what went out. And our ending balance, we had $78,000 in the bank. Now, it looks like this represents less than 1 month of cash on hand. I have a little formula built in so I can see that. And so as we are updating what's coming in, what's going out, our ending cash balance is going to shift as well. So we can see, like, for example, it looks like the end of May is going to be a pretty low month in cash, maybe 1 month of cash on hand. Are there actions that we might want to take today to increase that cash balance? Try and move a campaign forward or delay some expenses, whatever it might be. The idea here, though, is just that you have some increased visibility to really be able to make decisions today that are going to impact you in the future. So I love a forecast and I incorporate this into what I do monthly. So my routine is that I'm doing my bookkeeping, I'm reconciling all of my accounts. Then I'm running those financial reports that we talked about, those 4 financial reports, and calculating some metrics with those to really understand my financial health today and also my financial health trends. And then I'm forecasting the remainder of this fiscal year and usually into next. Every single month, this is my routine: bookkeeping, reporting, and forecasting. Those are the 3 things I do every single month. Then annually, we are creating our budget, right? The budget happens once a year. Annually, we're setting our cash reserve goal. And annually, I usually do like a 3-year forecast. And so, like, big picture, I'm kind of doing that on an annual basis as well. That does not need to be done on a monthly basis. Okay, so some best practices for forecasting. Finance teams cannot forecast alone, right? I do not know, what development has in the pipeline, what the fundraising team is working on. I do not know what the program team's plans are. So we need everybody to kind of come together. And where I find this most effective, I actually have a monthly meeting with my client where we bring in, people from the finance team, or yeah, people from the finance team. We bring in the individual fundraisers, the grants team. Everybody comes together to review the forecast and to contribute and work together to update the forecast. Because again, program and development, they know what's changing. I like to keep it super simple. We don't need to like go into a ton of detail, right? At the end of the day, we're sort of just predicting into the future. It's not going to be perfect, but it's better than not doing it at all. And then again, I've mentioned this a few times, but making sure we're forecasting far enough ahead to really give us some meaningful vision, right? If we're just looking 3 months ahead, that, we probably don't have enough vision there. Okay, so this is our sort of our last action item that you might want to incorporate, but how can you incorporate better forecasting and financial visibility into your routine? And so if you are not a finance person, maybe this is something you can talk to your finance team about. Hey, do you have a forecast? Like, are we forecasting? And if so, like, can I be part of those meetings, right? This might be something really valuable for you. So I said that I was going to ask you. I see some questions in the chat. We are going to get to those. But before we do, I would love for you to drop into the chat one thing. You don't have to write all three, but one thing you're going to do to take action on after our time together today. So drop that into the chat. And then let's see. Okay. I want to share this with you. I do have this resource. Like I said, you're going to get the slides, you'll get this link, but this is a cash flow forecasting template. So it's like what you saw a couple of slides ago, so that you do not have to create a template from scratch. You don't have to stare at a blank Excel screen wondering how in the world do I create a forecast. So you can grab this, and if you're not a QR code person, if you go to 100degreesconsulting.com/MNN, like Massachusetts Nonprofit Network Finance, you'll be able to grab that there. All right. Okay. All right. I'm seeing some action items come through. Robbie's going to work with accounting on more forecasting. Love it. Myra is going to review this presentation again and pull the reports. Fantastic. Jennifer's going to update her forecast more often. Esther is going to suggest we start making forecasting for 12 months instead of just the last couple months of the fiscal year. Yes, I love that. Yeah, much better visibility if we can look a little bit further ahead. So good. Thank you for sharing those. Let me get to some questions. Just in the chat, I see this one from Celine. When payroll is the org's largest expense, what info and which experts/staff should be involved in determining program by program cost to determine expense ratio? Yeah, so I'm not entirely sure I understand your question, but if payroll is your organization's largest expense, I would imagine then that your staff is likely spending significant time on programs, maybe a little time on admin, maybe some time on fundraising, but we want to make sure that that we're allocating their time. And so it's not just ending up, dropped into admin or just dropped into a general program bucket. We want to make sure that we're allocating their time across whatever programs they're spending time on and admin and fundraising, so that we can see true program costs. So usually this is done based on timesheets, based on how we're actually spending our time. And you likely will need an accounting entry in your accounting system to be able to split that basically so it doesn't just end up in one bucket. I'm not sure if that answers your question, but we definitely want to make sure our time is allocated. Okay, Jim asks, calculating expense ratios. Oh, I think that's your action item. What expenses are typically included in expense ratio calculation? So it should be all expenses. Like every expense in your accounting system should be categorized as either an admin expense, fundraising, or some type of program. You probably have multiple programs, so you might have different codes for each program. So we want to make sure that all of our expenses are categorized by one of those three so that we have a really accurate report there. Maybe you've got like office supplies, and some of those office supplies are actually just for the admin office, but then some of those office supplies are actually for your programs, right? You need markers and paper because you have a after school program for elementary school kids, right? Whatever it might be. So you want to make sure that those expenses are categorized accurately as either admin, fundraising, or programs, and it should be every expense should fall into one of those buckets. So not sure if that answers your question, hopefully. All right, I'm going to pull up the Q&A. So Jennifer asked, can you give some guidelines about restricted versus unrestricted? And I'm thinking this popped up when I was looking at the percentage of net assets that are restricted versus unrestricted. Yeah, there's no right or wrong, but I think we'd want at least, 20% unrestricted at the bare minimum. I know one organization that was aiming for a goal of 40% restricted, 60% unrestricted, right? So I think it depends on your organization, but you want to make sure that you have at least enough unrestricted net assets to cover whatever your like your operating expenses are, right? So that's why it's important to know what that number is. Um, but yeah, we want to make sure that that number is strong. So it definitely depends on your organization, but 30, 40% I think would be a good goal for unrestricted, if not higher. Um, Jennifer also says, what's your recommendation for how many months of cash on hand nonprofits should have? I did touch on this, I think, a little bit. I said 3 to 6 months is a great place to start. I think it really depends on your organization, and on your really on your expenses, on your revenue streams. I know some organizations have like really big peaks and really big valleys of revenue, so it's not consistent month over month. And so if that's the case, if your revenue is very volatile, maybe you want a higher cash reserve to help you sort of fill in those gaps when that happens. So it depends on your organization, but I think a very broad rule of thumb would be like 3 to 6 months. And then Elise says, will these templates be available after the meeting? Yes, you see that up on your screen right now. So yes, they absolutely will. All right, fantastic. I think we tackled everyone's questions. But yeah, I have a couple more minutes. If anyone has any others, I'm happy to answer. Otherwise, yeah, it was great to be here with you all, and thanks for your time today.
And thank you, Stephanie, for sharing this great presentation with everybody. Just to reiterate, we will be sharing the recording and the slides. Keep an eye on your email. If a few days go by and you haven't received it, feel free to reach out to me. But in the meantime, have a great rest of your day, everybody. Hope you can enjoy some decent weather in Massachusetts right now. So yeah, well, keep an eye out for the next webinar, and thank you all so much.